I'm not kidding, this isn't clickbait. If the only chart you've been watching over the last few weeks has been junk bonds versus the S&P 500, you've known exactly when to sidestep the pullback and when to buy the dip. I won't make you wait until the very end. I'll tell you straight up front that this signal has been spot on. Notice in this screenshot that the bullish and bearish divergences act as the signal itself, and it worked beautifully on Friday, right? Because on Friday morning, there was a larger break in the market on concerns about the AI trade being overheated. But as of the close, the bullish divergence in junk proved that it would have been an absolute mistake to get short in the hole underneath the daily 50 SMA in the S&P 500. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPY weekly time frame, talking about candle structure and location, as we always do. In terms of structure last week, solid red-bodied bar with just a little bit of a lower wick, which of course would indicate that buyers tried to step up towards the lows of the weekly range. However, sellers still accomplished a fairly weak close in the lower third of the weekly range, so bearish on structure. If we're thinking about location on the bar-to-bar count, certainly a lower high as well as a lower low. Most importantly, a candle close completely outside of and underneath the previous week's range. Sellers go 2 for 2 on the bar-to-bar count. Is this really a shock, considering that the previous weekly bar was a bearish inverted hammer on a gap and go, an exhaustion gap and go in the upward direction that faded off the highs? Not really. As soon as we took out the previous week's low, it does make sense, right? Logical sense, that under that low you would experience a little bit more of a deeper pullback. Now, one of the major spots we were thinking about potential support was over the bearish engulfer high, but that didn't happen. So the next question becomes here, was the violation of the previous bearish engulfer high a concern from the weekly perspective? I want to be very clear here. From the weekly perspective, not the hourly downtrend, not the daily overshoot, but from the weekly perspective, has anything substantially changed about the uptrend that we're in? Or is this a mild pullback from the highest high in the trend count? I would certainly argue the latter, right? You could certainly come in here with a bit of a trend channel striking from this low, doing something that looks like that, perfect, and doing something along these lines. We've pulled back from the top of the trend channel to the bottom end of the trend channel, and we did start to find buyers there, hence the lower wick that printed on the weekly bar. If we clear this up and take a peek at our anchored VWAPs, any violation of the anchored VWAPs? Well, we overshot the pullback here and the breakout bar anchored VWAP here, but where did we close? Technically above the entirety of the stack, which is not bearish, right? If we take a look at our volume profile, let's take a peek at this one. I've done my homework. I'm pleased to announce, right, that the high volume node certainly acted as support. The lower wick found buyers right near this high volume node, and we've closed above it. That's really not a bearish indication. So all things considered here, the weekly trend is still up. We've experienced a mild pullback from trend channel high to trend channel low. There's really nothing here that makes me overly concerned. Now, of course, I would keep a very close eye still on the quadruple bottom lows at 654. If we take that out, yeah, more trouble may emerge, but for now, the lower wick of last week's bar didn't even test that level. So 654 is the line in the sand from the weekly perspective. If we're above it, the bulls are on parade. Let's take out our Fibonacci's really quickly from the low here up to the all-time high. Notice that that 654 quadruple bottom low is technically above the Fib 38.2, which would qualify it as bull flag consolidation. If we bring out the Fibonacci's from the low here up to the all-time high, I'm just reinforcing the idea that if you do something that looks like this, the previous all-time highs from earlier on in the year are now confluence with the Fib 38.2. I would probably argue that this is more of a monthly pullback for a higher low at that point from the monthly perspective. The weekly trend may flip to down to actually get something that looks like this, but nonetheless, just reinforcing, right, that the higher time frame trends, again, higher time frame, I'm not talking about what happens on the hourly chart yet, we're talking about the higher time frames. There's really no concerns here on the weekly. Let's drop this thing down to the daily chart and let's see what's going on from this perspective. First evaluation tactic will be the expected move for the week. That is this gray box right here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner on how to set it up. If we're contained by the upper bound, the number is at 683.45, and that does technically imply a lower high in the trend count. That is a concern. That's bearish. If we're contained by the lower bound, the number is 658.49, and that would be a higher low relative to the bearish engulfer low from the China reignition of tariff fears, so to speak. However, it is still firmly inside of this junk drawer. We have clearly overshot the top end of the bearish engulfer. Not thrilled about the expected move here. It does strike me as being slightly more bearish, maybe neutral, but definitely not bullish, not forecasting any sort of major higher high at this point. But the next question we might follow that up with is, okay, well, what's technically happening with the trend here? Is the daily trend actively down yet? I would say it's close, but we're not all the way there until we actually form a concrete lower high underneath this level. And this is going to be the major tension that we'll talk about in today's analysis, which is the ideal higher low, right? Pulling back from the highest high in the trend count would have looked something like this on the daily time scale, bearish engulfer high, daily 20 SMA, previous lows in here, previous gap close as well. That would have acted as your picture perfect higher low. But the next thing we could evaluate is, okay, what was the last higher low in the trend count? Well, the hourly trend did flip to down in here, of course, and this was a major low. Was there any hourly downtrend aside from that? You could maybe argue for this here, right? This was hardly an hourly downtrend. It was very short-lived, and we snapped back very hard the next couple of days. So if this is the last major higher low in the trend count, is it possible to still consider this a higher low in the daily trend count? I lean towards saying yes. I could understand why you might argue for a little bit more of a neutral, equal low as opposed to a higher low, but for the sake of argument in the current trend count, I think the focus needs to be on whether or not the market can recapture the bearish engulfer high in here at roughly this 674 area. If the market sets a lower high underneath the daily 20 SMA, then our worst fears are confirmed, and oh my goodness, we have to start talking about the possibility of a daily head and shoulders. But let me remind you, right? This also was the possibility of a daily head and shoulders, and therefore, what do we say around the channel? What's the common slogan that I always reinforce? It's not a head and shoulders until it is, aka you need to break down through the neckline, you need to bring in a lower low. So the tension I see as we move into the upcoming week's worth of trade is what happens with this level right here at 674. Do we retest the daily 20 SMA from the bottom side and reject for a lower high? Or is there a prompt recovery? In which case, if we get a higher low over the level, I think it's rock on. I think you have a support point here over the daily 50 SMA, sellers unable to close underneath, a reclaim of the daily 20, and the bearish engulfer high, in my view, likely sets us up for a move to continue back up towards the all-time highs. The daily trend will remain in the upward direction. The weekly trend will remain in the upward direction, and this will go down in history as a pretty substantial overshoot of a critical area of what was once acting as resistance, possibly trying to act as newfound support, but nonetheless, the recovery effort on the backside will be notable. So this is only on a recovery and recapture up and over 674. As we'll see through the supporting evidence, it's not overwhelmingly bearish. It's definitely concerning out there, but it's not, oh my God, sell everything, the market's moving in the downward direction. Huge tempo, huge, panic across the sectors. I mean, you can even see here just based on the weekly performance. We'll talk more about this when we get into the sector analysis, but there's some level of rotation going on here with some sectors green, some sectors red. Obviously, your semiconductors and the AI trade feeling the most pain, being the heaviest weight components of the S&P, are going to cause that drag, but it's not like everybody is panicking out of everything, and it's a mass sell condition across the entire S&P through the different sectors. So that's your daily analysis here. I would really just mainly focus on what happens early on in the week at 674. Do we retest for a lower high underneath and stay in an hourly downtrend, or do we recapture that level, in which case I believe it's bulls on parade trying to move back up towards the all-time highs and continue this trend in the upward direction. If we are going to move to the downside, so without a test of this 20 SMA first, if we're going to move lower, I would be very, very skeptical of being positioned in a overly biased way inside of what we know is the junk drawer, right? That's what JD stands for over here. The junk drawer is an area where you stick your hand into that junk drawer, you rummage around, you're looking for, a couple bucks or whatever, you pull your hand out, you might have a couple of paper cuts, maybe you found a couple of pennies, a dime, a nickel, a quarter. You definitely didn't forget a $10,000 check inside the junk drawer, okay? So it's the same thing with trading. Don't expect huge outcomes in this area. I would be very, very reserved, very open-minded, smaller position sizes until we're out of this to some degree, okay? So those are my concerns to the downside. If we do just get a straight-up rotation that looks like this, very, very not Well, I guess I'll just say it. I'm not pleased to be trading back down inside of that area. I would definitely dial back my own trading activities, and then things will really start to clarify to the downside. If this market, like here's a one take as well. If this topping process is really going to be on the table, and oh my goodness, the market's going to crash 20%, there's going to be plenty of time to short the market underneath the weekly quad low, right? That's that 654 that we've been going on and on about. There's going to be plenty of range and plenty of time to short this market underneath that level. I don't feel like I have to nail it in here inside of the junk drawer, okay? So those are my thoughts on the daily. Let's quickly take a look at the hourly, see what's going on from this perspective. We know that the daily has clearly moved lower because of the hourly downtrend, right? Highs, lower highs, lows, lower lows, lower lows. This even was a lower high here. And there's still the possibility of an hourly lower high, which is why I'm not convinced quite yet that until we actually take this out, it's not all fine and dandy, right? You can still clearly get a lower high. Let's say that on Monday morning, we open either back in range here, or we rally and look above and fail back into the range. This will just continue to look like a lower high in the hourly trend count, and we will not have a definitive daily low in until we change that trend back to up. Now, of course, the more optimistic take here, if you're a bull, is you want to see this trend reverse. And how might that happen? Well, here's a classic example, right, of the inverted head and shoulders. Left head, right shoulder wants to maintain higher lows over 669.65. Then a break of our daily key level here is what would bring in the higher high in the hourly trend count. The hourly trend would flip back to up here, and that's where I would say with a little bit more confidence, we have a better chance at a firm daily higher low being on the table in the S&P 500, looking for that upside continuation over time, back up towards the equal high, if not higher highs, to continue the trend in the upward direction. So this is the optimistic take here if you're a bull, but once again, considering that we've overshot, take a neutral approach first. Obviously, there's been a very sharp reversal off of the lows, but a neutral response first is the primary idea. We could easily rally and reject. If we get a lower high here, maybe a last-ditch effort would be to set a higher low up against the junk drawer high. That's a possibility, but I would tend to think, right, especially if we have the headlines to complement, this is, it's not unreasonable that the market may reject this for a potential lower high. So you can clearly see, again, this sort of tension in the analysis here where I'd like to be willing to try to look long here. However, if we're underneath this key structure, it's still technically bearish on the hourly timescale. A couple of things I want to point out here. If you were a stronger seller on Friday, and this sort of aligns with that HYG signal we talked about in the intro, on the gap down Friday morning, you would have ideally loved to see, as a seller, right, a lower high underneath the junk drawer high, underneath this pivot low from back over here. So if we ask the question, did sellers get that? Clearly the answer is no. So that in the short term makes me think, all right, stronger sellers didn't really accomplish that. What about the gap fill reversal into the close? Was there some sort of like touch of the gap close and then a prompt reversal into the close of Friday? Survey also says no, and buyers battled for acceptance inside of Thursday's range. So all things considered, the immediate price response from Friday does not strike me as being overly bearish on the lows. If we had stronger sellers, you would have seen price acceptance in the junk drawer, or at least a gap fill reversal underneath 669.65 to really keep prices moving outside of and underneath the Thursday range. It just didn't happen. So once again, a neutral approach, in my view, is the correct approach inside of this box here. More bullish over the 674 as we've described. If we reject this area, I would definitely start looking for shorts again underneath 669.65 and just straight up continuation of the hourly downtrend. Let's come in here with some Fibonacci's from the top to the bottom of this move. You can see that the Fib 50% is along the lines of that big delimiter, if you will, of price, 674. The Fib 61.8, not really aligned with anything that's in play immediately, but it is aligned with key structure. This general zone in here is important. Remember that on the Wednesday session, right? Ultimately, if buyers were going to get the job done, they should have battled for acceptance in this range rather than allowing a lower high to continue the hourly downtrend. So the sellers do have an edge there underneath that 680 zone. The other fib I want to pull is from the low in here up to the major high, just to reinforce that this Fib 38.2 is smack on the money with our, as I just called it, delimiter. It's the line in the sand, whatever you want to call it. That 674 spot is reinforced from this perspective. I would also point out that if you're a stronger seller, you want to see more price acceptance underneath the Fib 61.8 for something that looks like this to really build out higher chances to a 100% retracement. Remember, the more time you spend underneath a fib 61.8, the odds dramatically increase for a 100% retracement. We just didn't get that on that Friday session. So once again, reinforcing that end of day rally on Friday really tells us quite a bit about the types of participants who are getting involved in this market. It doesn't seem like it's an overwhelming amount of, oh my goodness, sell it all and, don't rotate into anything. No, it seems like a rotational market as this pullback has unfolded. Yes, the heavier weight pain is happening in the tech side of things, the AI trade, semiconductors, the whole 9 yards, but it's not an outright Armageddon, which I would reinforce once again, just purely looking at the S&P sector performance, it's not all red there. When the market's going to crash 10%, 20%, 25%, it's sell everything. We don't want to own a darn thing. Right? Sell it all. Get rid of it all. Everybody's panicking. There's blood in the streets. You're not going to see a single green sector. It's not what we're working with. Let's take a look through the anchored view apps here and see what's going on from this perspective. Intraday anchored view apps. There we go. Come on, click. So we've sort of simplified here. We have the all-time high anchored view app. This is the bearish engulfer anchored view app. And notice once again how they're sort of barreled around or tangled around this major level. So although I might seem like I have a little bit more of a bullish tone here, which admittedly I do tend to have a little bit more of a bullish bias on the market, I think it's most appropriate, and I'm trying to say this out loud to even correct myself a little bit, but it's most appropriate to maintain that neutral stance here and only go back to full-blown like, okay, it's time to rock and roll when and if we get this firm recapture and hold up and over that 674. If we're underneath the level but over 669.65, I think that neutral approach is correct first. And then if we start dropping and setting an hourly lower high, then fine, the pullback may continue here. Those are your compelling, additional arguments, fibs and anchored view apps on the S&P. Let's take a look at the market internals here. If you're not familiar with the market internals, check out the video tutorial in the top right-hand corner. Here's another one, right? If Friday was really this major gap down and sell it all, it's just going to be Armageddon. Why was it that your volume inflows were the most substantial on the week during Friday's session, right? That is a fairly substantial reversal in the upward direction coming from that morning low. So I really like what I'm seeing volume commitment wise. It was much more than, an equal opposite than what we saw from Thursday. If it was strong new money sellers really driving this market in the downward direction, you would have seen Tuesday on a rinse and repeat, Wednesday, Thursday, and then Friday into the close, breaching negative 300 million, and we just didn't get that. Very neutral on Thursday, and then followed up with bullish continuation-looking volume on that Friday session. This, to me, is a little bit more indicative of new money buyers stepping up at that daily 50 SMA, which we haven't really seen in quite some time. If we look at the advanced decline line, it's the same thing. You would have expected on larger sell-side activity, specifically on the Thursday session, right? Why was it that sellers couldn't get the advanced decliner underneath negative 2,000, underneath negative 1,500? Why were we not in trend lower zone down here? Just didn't happen. Again, I'm not arguing intraday that the market was bullish and, oh my God, trading longs was the best idea in the world, but it just wasn't as bearish as it could have been, and we can clearly see here, advanced decline line closes positive on Friday. I would say similar out of the cumulative builds on the tick. By Thursday midday, we were actually at that threshold. Negative 2,000 is typically indicative of a trend day by 12 o'clock. So the fact that these didn't get any deeper than negative 2,000 after noon, to me, once again, is another sign that stronger sellers did not continue to lean into this market as the day came into the afternoon session. It was more like, okay, morning liquidation break. To me, it's more of a look like buyers who are trapped long at the highs from the gap and goes of now 2 weeks ago. Those buyers are the ones liquidating. They're the ones who are like, oh my God, this is terrible location. Let me sell this. It's not outright sell it all and stronger sellers hitting the tape. It's liquidation break from the highs is more so what I'm seeing here versus anything else. So that's a run through of the internals. Let's take a closer look at the market profile here. Let's give the data a little refresh for good old Min. What do we see on the value area? And by the way, if you're not familiar with market profile, what this is, check out the video tutorial top right-hand corner. We've always got you covered. So in terms of the value area on the week, it did shift lower, right? There's no arguing with that. Value certainly shifted in the downward direction, with Friday value closing fairly low in the individual profile. But typically when this happens towards the bottom end of a move, not when we're just in consolidation, but rather when there's a deep pullback, right? What this would start to indicate to me is that now if people are positioned from the long side, from the bottom end of the move, it's going to give us more leeway basically to pull back into the previous day's range, Friday's range, catch support over value area high, and try to build out that hourly high or low. Versus if value area, just think through this from a conceptual perspective. if value area was higher in the individual profile, if everybody was committed from up here, there was a deeper pullback into this. Okay, now all of a sudden we're biting our nails. We're like, okay, positioning isn't really all that great. If we start to drop value area low, it's continuation, right? Versus in this instance, what we currently have in front of us, we move into the range. Okay, everybody is still fine. No, everybody, quote. But most participants, 70% of the volume transactions down here, everybody's still feeling okay. And then if we could sustain value over this, there's a better chance that value could start to build out in the upward direction. So I do like the fact that value shifts lower in that individual session, indicating that trade location participation levels are towards the comfortable side of the range, not the top. Right? People weren't buying this up at the tippity top of the move. People were buying this as the pullback was unfolding through the midday session. So I like that. There's a thin volume void in here. I think it would be very reasonable. You could pull back to this midpoint-ish of Friday's range, try to catch support over the value area high, and set that 1 hour high or low. Right? 1 hour high or low is the name of the game, and market profile would seem to agree with that. Another indication that we could take away from Thursday is liquidation break, A period. It's not quite a perfect B-shaped profile, but it's pretty close. A period liquidation break, once again, is more of an indication that stronger sellers, not really there, it's just emotional sellers. And then carry forward this as well. Wednesday's high is incredibly poor, right? Look at that, GHIJ periods flat across the top. If we retest Wednesday's high, I would expect the market to break that level on the first test because it is a poor high. Let's go back on over to the charts from this perspective, and let's take a look at our good friend the QQQ nasty NASDAQ. Let's see what's happening from a weekly perspective. We'll do the whole 9 yards and we'll evaluate what we should be thinking about here. So clean drawing set, perfect, and here we go. So on the weekly bar, it's very similar in terms of its candle structure, solid red bodied bar. We do have a lower high as well as a lower low. Candle closed completely underneath the previous week's range. So same indications there, same indications about the general trend remaining in the upward direction. This is a pullback from the highest high in the trend count. You could come in here with a weekly trend line on the NASDAQ and notice that your lower wick doesn't even touch the weekly trend line, right? So you got a little bit more parabolic as the AI names acted more influential over the move in the upward direction, and the pullback, therefore, it's come a decent way from the highs, but not quite enough to bring it back to that linear trend, so to speak. If we come in here with the Fibonacci's, we won't really learn much new, but we can do something that looks like this. Over the Fib 38.2, no problems there. Clearly over this Fib 38.2 as well, just reinforcing that this is confluence back here. If we come in here with the anchored view apps on the Qs, let's just do this real quick. Over the entirety of the stack, I didn't add the breakout or the pullback anchored view apps, but it should be similar dates. Let me just do that. Yeah, it's actually spot on. Closing right on the top end of the cluster there, so really no concerns after a subtle overshoot of the highest in the stack. If we come in here with the volume profile, let's check in on our high volume nodes. We could just extrapolate this one right here, and lo and behold, it's perfect right on the lower wick of the weekly bar. So a lot of the same indications here on the QQQ weekly. There's no major concern about a weekly reversal. Yeah, there's some downside pressure, but for the most part, the trend is still intact, and we are not even close to testing those quadruple bottom lows back over here, about 588 on your QQQ NASDAQ side. Let's take a look at the weekly expected move first. Here it is in this box. The upper bound is going to be at 625.96 and the lower bound at 593.52. Very subtle higher low versus the bearish engulfer from back here, a very not so subtle lower high versus the all-time high in the market. You can clearly see the hammer structure on the Friday bar off of the daily 50 SMA, but once again we have closed technically underneath this major area of previous resistance, which in a picture perfect world would have acted as support for the daily higher low at the close of Thursday. Friday, let's speculate here or just conceptualize what would have the ideal Friday bar looked like. You could have opened where you opened here, but something that looked like that would have been much more compelling. You would have said, okay, you opened on a little bit of an overshoot from the key level, but you rallied to close inside. Fantastic, no issues. We didn't really get that. I think the market is set up to possibly follow through for something along those lines on the Monday session, but once again, you have to see it to believe it. So the first thought here coming into the new week is neutral, open-minded to a break and a higher low over something like 613.17. That's the exact high of the bearish engulfer from back here. If we get that, I'm open-minded to the upside coming back into this market and not just like, here's the thing, right? And we talked about it on the Friday morning session. As you were breaking this and gapping down underneath on Friday morning, you had to change your tone a little bit bearish, right? But to change your tone bearish at the very bottom of a move as the pullback is unfolded is a little bit of poor form, right? You never really want to be short in the whole, short at the lowest low of the move. You want to be short on the lower high. So it was very difficult on Friday to want to short that move to the downside, and I think rightfully so, because this is the next place where you would optimally position for a lower high, right? And we talked about it on the SPY hourly, of course, but it's the same concept in the NASDAQ. If you're going to get this counter trend to set a lower high, you just want to reject this, and now all of a sudden you can at least manage risk for risk reward along these lines in here, trading back down to the equal lows of something like the junk drawer. Okay, so that is your QQQ, supporting currently off the daily 50. Once again, neutral to start the week, very open-minded to something that would look like this potentially, but equally as open-minded to consolidation and rejections below 613.17. Keep the pressure on. The bears are in control. There we start talking about the head and shoulders, possibly a neckline break, which could be a trend line at this point. Depends on how this unfolds. Something that might look like that. Again, speculative at best currently, but a lower high that comes into it. We'll talk about it when and if it happens. You need to see it to believe it, but for now, this is probably what I'm most open-minded to early on in the week, and then this is, it's right there with it, but based on some of the evidence that we'll explore in today's episode, I do believe that this is something that's reasonable. Let's continue along to the hourly chart. Let's see what's going on from this perspective. Let's come in here with the fib, of course, the classic pull from the top to the bottom. 38.2 is right on the money with our perfect spot. So if this is just a counter trend move, which it currently could be right now, then a lower high at the zone is exactly what the bears want to see, and you'll start rotating in the downward direction. So if you're bearish, and if you don't believe in the supporting evidence leaning more bullish than bearish, if you don't believe in the market rotation, if you think that the big AI Mag 7 names are going to continue to sell off, then by all means, this is the place to do it. This is where you want to start looking for shorts. Under the fib 38.2, call it bear flag consolidation, right? This is fine. Lower highs here, retarget the equal lows. There's nothing wrong with that. That is a reasonable outcome if you believe that the supporting evidence does not lean more bullish. Now, I will say here, on the NASDAQ side of the market in particular, you didn't really have that full gap fill and price acceptance inside of Thursday's range. You can see on Friday, you closed still cleanly underneath Thursday's range. So therefore, would it make more sense to align your shorts with the NASDAQ versus the S&P 500? I think the answer to that question has been and will continue to be absolutely. Why? Because of the AI concentration, because of the tech concentration. In the S&P 500, you have the ability to get rotation into things like, financials, into things like real estate, energy, all these other, consumer staples, utilities, materials. You have all these sectors that can potentially rotate or allow for rotation and money to move from one to the other, which will keep the S&P at least from falling off of a cliff, but you don't really have that in the NASDAQ 100, much more narrow in terms of its opportunity. So because of its concentration, if you're looking for the short, if you believe AI stuff will continue to roll over, this is where you want to do it. Avoid the S&P 500 like the plague, set the lower high here, and then you're rocking and rolling on the NASDAQ. Obviously, the hourly trend remains in the downward direction. Clear lower highs, certainly an opportunity for a lower high. That's what we've just been arguing about. This trend will reverse when and if you start to set a higher low over that area. Nonetheless, if you bring in a higher high over the daily 20 SMA, over this previous pivot low, this lower high in here at 616, that's the number to beat. As soon as you have a higher high above that, the hourly trend is flipping to up, and I would no longer maintain any semblance of a bearish tone on the market, noting that the daily trend would be up, the hourly trend would be up, the weekly trend would still remain in the upward direction. This gap overhead is the first major target. That's going to be around 627 to 629.75. Let's come in here with the anchored view apps intraday just to take a quick look. And where's the study? There it is. What do we have? Lo and behold, it's the sweet spot, right? So this lower high rejection in here, very reasonable. I may sound a little bit more it's not I may. I know I sound a little bit more bullish in the S&P 500, but I want to draw the distinction between the two big indexes right now. If you're going to look for shorts, and if I need to look for shorts early on in the week because the market just doesn't have that bullish pop to it, the NASDAQ's where I'm going. I'm looking at the, NQ, I'm looking at the MNQ and scaling into, 20 MNQs or whatever, and, having that ability. The stops are going to be wide. The volatility is clearly rocking here. Having some flexibility, MNQ, NQ, QQQ options, maybe we shall see. But that's really it, right? I would look for the Qs on the short side. Let's take a look over at our market internals, see what's going on over here. NASDAQ does not have as substantial in terms of substantial amount of volume inflows to end out that Friday session. The advanced decline line just gets hardly back to the zero line, and it was technically in trend lower zone here as well as Thursday's session. Again, clearly displaying the divergence and the narrowness of breadth in the NASDAQ. You had a much deeper bear build on these sessions here out of the cumulative read. You can also see the volume flows getting a bit more substantial on that Tuesday, Thursday here. And I think rightfully so. This supports the argument we've made thus far that you want to be more bearish in the NASDAQ and a little bit more reserved in the S&P 500. Let's take a peek over at our good friend, the market profile on the NASDAQ, and we'll finish it up over here. What do we see? Well, certainly value continuing to move lower. You have your liquidation break on that Thursday session. You have a value area which is lower on Friday. I think it's a lot of the same commentary here. If there is going to be a counter trend move, now is the time to do it. And notice I'm being very careful with my words, right? If we just go back on over to Thinkorswim, I still want to be very clear that this is an hourly downtrend, right? This is still a counter trend move in the context of an existing hourly downtrend. Just like on the daily time scale, this is an uptrend, and this is a pullback in the context, counter trend move in the context of an existing uptrend. Okay, so looking over at the market profile again, let's just go back over here. If we're going to stage and continue this counter trend on the hourly, then you just need to stay over value area from Friday. It's kind of that simple, which it's honestly the nice easy number is 25K on the NQ futures. As long as we could stay over that, no problemo. Let's see if we could stay over 25K in the NASDAQ headed into the early stages this week. If so, I believe that there's a possibility of the counter trend continuing. I will just point out that we have a little bit of a spike. I'd say lack of material excess down here on the lows. As it was zoomed out a little bit, you sort of saw how we have E and F back to back. As you zoom in a bit more, you get a little bit of a TPO excess there, but not much. I would say it could technically use some repair. The spike in M period is not substantial or severe, shall I say. If we open or stay over the spike base, which is at 125, then I would just maintain more of a bullish edge here, thinking about the counter trend continuing anyways. Let's get back on over to the platform and let's take a peek over at our good friend, our next good friend. Every index is our good friend, I suppose. The IWM, what's going on with small caps here? Let's take a peek on the weekly chart and see what's going on. So candle structure is clearly different. And the reason I say that is because we have much more of an equal sized lower wick as we do body of the candle, right? So to me, it's a little bit more neutral as opposed to outright bearish. It starts to look a little bit more hammer-esque in nature. And therefore, if we were to take out the top end of that weekly hammer, is it possible we could float up to the all-time highs? Certainly seems reasonable to me. The overall trend here is still up. I would call this more so consolidation as opposed to an outright reversal. You are supporting near this shelf of lows in here, so I'm not overly concerned about a larger downside break and bringing in some sort of major lower low. If we come in with the Fibonacci's from the bottom of the move to the top of the move over the Fib 38.2, from this low to this high, 38.2 continues to act as support. In my view, this is bullish. Let's take a look at the anchored view apps for our small caps. Perfect off of this pullback. Awesome, acting as support right at the cluster of lows. I think this looks great. On the weekly perspective, no major concerns about smalls. We know that Jerome Powell's commentary about dialing back expectations of a cut for December sort of put the pressure on ever since that Fed comment, the FOMC comment, what was that, 2 Wednesdays ago now? So that pullback has taken place, but nothing so substantial where I'm like, oh my goodness, the small caps are crashing. We're just not really there. Comparing to this previous high, you've closed right on it. I would think that the main thing to watch for here is just continuing to, day by day evaluate the range that we're stuck in. We'll see this range in a second. Just want to go volume profile here for a moment. And I do want to look back at the previous all-time high just to make reference to it. 15 years is not needed, but the point being is this high volume node. As long as we're over that, weekly higher low, monthly higher low, 225s, really all set here for small caps. Let's go on down to the daily chart and see what we can learn about the weekly expected move in this balance range I've been referencing. So here's the expected move. The top and bottom actually align beautifully with key technical levels. The top end is roughly 248.35. The bottom end is roughly 234.87. If we're contained inside of this expected move, I would still maintain a neutral stance in the IWM. You can clearly see this as the major overhead range. Look at where we closed on that Friday session. If we can lift back into the midpoint here, very, very neutral, and you can't be bearish, right? The market really would require a more severe lower low, a closing lower low, underneath these previous lows, too many lows, at 238.50, and we just didn't get that on Friday. So all things considered, neutral, very, very neutral, and it's tough to have an S&P 500 that's falling off of a cliff if you have something like small caps indicating much more neutrality and balance, right? There's not much of a clean downtrend here, although you can maybe argue double top-ish. You just haven't really accepted for a severe lower low yet based on Friday's close. So keeping it simple on the small caps daily, let's go to the hourly chart. Undoubtedly, hourly downtrend here. There's no arguing with that one. You have highs, lower highs, lower highs, lower highs. If you reject this and stay underneath, oops, there we go. If you reject and stay underneath 241.65, I would certainly align more so with the bears trying to break down. But again, you need to see it to believe it. Under 241.65 maybe dials back my expectations of a severe recovery effort in the S&P. But if this starts to move into the neutral territory, then it's game on. In the S&P 500, it's game on if we're in here, right? So that's the major watch on small caps, the main level, 241.65. We could quickly throw on the intraday anchored VWAPs. These aren't as valuable. They look a little bit more random, of course. This is the midpoint of a balance range. There's not much to read into there. And we can also, we should take the fibs out, maybe from the top to the bottom in here. And lo and behold, the no man's land is quite literally inside the midpoint of that balance range. I would just align with the idea that this could be bear flag consolidation underneath the fib 38.2, which we just described anyways from a technical structure perspective at 241.65. So the line in the sand is quite clear on smalls. Let's jump on into our not S&P, but Russell market internals. You could see that we did not have severe volume inflows. We didn't, kind of neutral tick here into the close on Friday. Neutral, closing over the zero mark on Friday. There's nothing in the internals for the Russell in particular that are substantial or compelling, right? If anything, this stuff would just align with the fact we've been in balance and there's not much of an edge. And when and if we do get that larger lower low, or when and if we do get that larger higher high, then it becomes a matter of confirming that the internals are acting in accordance and not divergent. We just don't have that consideration to make yet, and therefore we will move along into the market profile. I was going to say good friend again, but I figured, you know what, let's not overuse the term. So what do we have over here? A couple of double distribution days, namely Wednesday and Friday. You could see an E period over here and J period over here on Friday. So a simple watch early next week will just be, do we open and stay within the upper distribution? We'll call that D1, or do we open and stay within the lower distribution? Very simple stuff here when it comes to market profile. If you're in distribution number 1, bulls on parade. Buyers do have the upper edge. If you fail and start accepting down here, let's say Monday's value area falls into distribution number 2. If value area is here, guess what? Bears are taking that edge, and it's very likely we try to get a push in the downward direction. Why is this the case? It's the exact opposite of what we just talked about on the S&P and the NASDAQ. If buyers are getting involved at these elevated prices, hence the value area shift in the upward direction, anything that's underneath that suddenly puts those guys, oh my goodness, not so great. Maybe it wasn't such a good idea to buy small caps. What do we have to do? Let's liquidate the position. You're moving into distribution 2 a little bit more easily. So it's more possible, in my view, that the weakness of trend on the Russell could resolve to the downside. I have much more of a bullish bias in the S&P and the NASDAQ based on the just simple strength of the trend, where we are in the trend counts, versus the Russell, which is clearly more neutral. So I think it's very fitting that the value area actually looks like this. Let's get back on over to the platform. Let's take a look through our sectors and see what's going on from that point of view. Let's zoom in a little bit on the S&P just so we can see the context in which this is happening. So who was leading, who was losing, and where was the weight? Real estate leads the pack up 1.95%, followed by energy, healthcare, and financials. We know financials are the second heaviest weight sector, so it is it's a meaningful indication that this was not red on the weekly performance. Otherwise, I would say, yeah, it's definitely more of a concern for the S&P. But for now, this immediately starts to bring up the rotation thesis. Not everything is being sold off here. There are some green spots, especially heavyweight sectors, financials being the second, in the market. If we look at the bottom of the barrel, it's the SMH, semiconductors, followed by tech. This is the heaviest weight sector, clearly a sign of weakness, being down over 5% on the XLK, followed by discretionary and then communications. So some heavier weight risk on sectors are definitely taking the beating here. There's no getting away from that. But once again, in an Armageddon situation where the market's going to sell off and crash 20%, there's going to be no green sectors. Or there might be 5 basis points in the green from materials and consumer staples because they're defensive, but that's it. Right? Well, we didn't really get that. And primarily, I'm reading into that XLF up 86 basis points. Once again, rotation theme seems to be alive and okay for now. If we look at real estate, no comment, just bouncing off the bottom end of the range. Fine. If we look at energy, trying to navigate into the top end of the range. Really no comment here either. It's not like it's sell everything. If you look at healthcare, looks pretty good as a bull pennant to me after breaking out of this multi-month base. This looks pretty darn good. And healthcare, it's no longer the second heaviest weight sector. Financials have taken that slot. It's no longer even the third or fourth. But it is still a compelling part of the market here, where rotation into that is going to be more indicative of a sustainable sideways move in the market, or just a healthy pullback rather than sell at all. Let's take a look at financials. I still have some concerns about financials. I don't really like the way that these lower highs are just persistently coming in. I don't like the way that this is technically a lower low. This is kind of just an equal low. So we are in a short-term downtrend on financials. The most compelling look here would be if this could resolve as maybe some kind of quasi double bottom. I don't love tracking the neckline as being the midpoint of this range, but I generally do want to see price acceptance back over 52.90. That would have me feeling a little bit more confident about what's happening in financials. And honestly, we've looked at this a little bit, but if you look at banks, they look pretty darn good. JP Morgan looks great. We can go Morgan Stanley looks similar. Goldman Sachs looks similar. Wells Fargo looks similar. Citibank looks similar. All these things are consolidating high and bull flags on the weekly perspective. The issue is that we now have Visa and we now have MasterCard, which are heavier weight, more so tech-driven components. They used to be in the XLK, right? They've migrated over to the XLF, and that's what's really putting the pressure on as of right now. Let's take a look at Berkshire as well. BRKB should bring it up. Is it a slash maybe on Thinkorswim? There we go. Berkshire even rallying over the last little bit post-earnings in here. Doesn't look all that bad. A break of a trend line in there could start to get this moving back up towards the highs. TBD, of course, I don't really see this as being a major contributor, but the lift here, at least, again, a compelling argument for the XLF as of right now. For anybody not familiar, you can always jump over here and just go XLF. And you can take a look at the top components. So there's Berkshire, JP Morgan, Visa, MasterCard, as we said. Bank of America we didn't look at, but we did look at Wells, all these other guys in here. We just saw some of the larger banks, right? So that is the look through the XLF and a deeper dive. Just making note that that rotation aspect still seems okay. Consumer staples bouncing off of a multi-month low in here. So that's compelling, but still a downtrend overall. This is D for defensive. The bounce is going to help keep your S&P neutral, but I don't think that this is a huge bullish indication as of right now. If we look at utilities, trying to hold up over this, we know that this has a little bit more to do with the AI trade and producing electricity and the whole 9 yards for those data centers. Materials still looks bearish to me as a bear flag down here underneath this overhead supply. I think with rates moving in the upward direction, it's going to continue to look that way. If we look at semiconductors, this is where it starts getting a little interesting, right? Because there's a huge overshoot of this, breakout point, massive breakout. This would have been the ideal higher low, just like the S&P and the NASDAQ charts. But look at where we've closed. If you're a stronger seller, you really want to see this, right? We just don't really have that indication as of Friday's close. Strong response off the bottom end of this prior range. Do we get follow through and lift? And easy in terms of watching it as an indication. Remember, execution is always the hardest part of trading. But an easier watch here is just, do we spend time on Monday over Friday's range? If the survey says yes, guess what? Probably not going to maintain a mega bear stance across the broad market. Here's the XLK, same comment, but notice how you do have a little bit more room to that bear engulfer high, which is here at 291.35. A lower high underneath that would be a nail in the coffin to start to develop that good old classic head and shoulders we've been talking about. And once again, it's only a head and shoulders when and if, let's put an asterisk on it right here, when and if we break the neckline. So that's the break, and that's the lower high underneath right here. You'd have to be underneath that 279 for me to really get concerned about a major reversal in the market. Let's go on over to the discretionary sector. This was looking okay for a possible break up through the highs, noting that we, after some of the earnings in there, overshoot, reconsolidate. It's a bit more neutral at this point. You ideally would have gotten a higher low cleanly over the abandoned baby low, and we just didn't get that. So 236 is now the number to beat. If you can consolidate back above, then fine. Maybe the ascending triangle thesis lives on, something that looks like this. We get tight and then break out in the future, TBD. But as of right now, neutral until proven otherwise. This is a heavier weight risk-on sector, so I am taking that into consideration for the S&P 500. Moving along to communications. Undoubtedly still in a downtrend here with highs, lows, and finally I shouldn't even say finally, was not rooting for this, but a lower low underneath this area of previous resistance, breakout, origin of the breakout, tried to act as support once, couldn't do it twice. I think there's now room for another lower high, and sequentially, the downtrend just remains intact. So a little bit of concern stepping up here in communications. We've seen some strength. We've seen some things that are like, okay. I'd say communications are one of the larger sectors here that are causing a bit of a headache. And if we just go back to the Analyze tab to show you, communications as of right now, 10.17% of the S&P 500 in terms of its weight. Let's get back on over to the charts. We look at the spiders. Let's go industrials. No comment, midpoint of the range. This is just kind of neutral to me. It's about 8%. And then the TLT, I'd be interested in some put sales on the TLT if this really starts to break down hard sub 88.25. The implied volatility just isn't there yet. So I'd be a bit more neutral here. I do want to see 88.25 potentially act as support, and then a move in the upward direction to hopefully put the pressure on rates to align with what the Fed has been talking about so far. So we shall see. 88.25, small line in the sand for now. Let's jump on over to the market ratios, right? Sector ratios. See what's going on here. If you're not familiar with ratio charts and Thinkorswim, check out the video tutorial top right-hand corner. XLK clearly pulling back here, which that was the glue that was holding the market together. So is anybody shocked? I don't think so. Really don't think so. I like the way that financials picked up a little bit of the slack here, and I think that this speaks directly to that rotation thesis we've been talking about so far. So I'm not overly bearish, and this is some of the supporting evidence that continues to suggest why. If you look at XLC, though, that is still a concern. I'd be a little bit more neutral here on discretionary, not full-blown risk off in XLV. Maybe if this breaks out and starts to get substantially higher, definitely not there in the XLP and definitely not here in the XLU. So the main question on ratios is, does this support for a higher low? I would tend to think, based on what we've seen on the structural charts, the answer might be yes. Let's jump into our specialized sets. This is still a higher low opportunity, higher low opportunity, higher low, equal-ish low. This is still a concern, and higher low to neutral. You know, that's actually right there. Yeah, not bad. Not bad. This is a bit of an overshoot, but you have the daily 50 there. So this doesn't lean aggressively risk off, in my opinion. I would think that this is still risk on, and this is your most apples to apples comparison. Everything else is tech or semiconductor related. So watching that closely, and for now it still looks somewhat healthy and a much more comfortable uptrend rather than being overextended and parabolic, so to speak. Let's jump into the B set. So far the ratios really have not suggested that, oh my God, duck and cover, the market's going to crash and burn. It's more like, things are slowing down, but definitely not bearish, right, in a major sense. If you look at the gold ratio, subtle outperformance here. Some of these AI fears have stepped back up, but nothing nearly as severe as what we had over here. Remember, the market was even rallying as that was taking place in gold. If you look at Bitcoin, it is underperforming, but what I will point out is the 100,000 round number, the Jesse Livermore number, is continuing to act as support. So I'd be very open-minded to a recapture of about 107. 107 is the range low on Bitcoin. If we were to get something that looked like that, that might be a reasonable take back up towards the highs. There's also a longer-term trend line in Bitcoin here. You come in from the lows or something like this. You just say, okay, is Bitcoin, does it need to drift, go a little bit more sideways and then catch itself here? It's possible. It's definitely possible. But the recapture of that could also do it on a look below and fail back under previous highs. Previous highs tried to act as support a bunch of times. If we can recapture that, I would not remain a big bear. I'll frame it that way. Would ideally like to see the Sailor Shift tool move back to bullish as well. In terms of TLT ratio to the S&P, not quite breaking out to a new high, but not also breaking down to a new low. Remember, we've inverted this recently, so if it's pointing in the upward direction, that is bullish and healthy for risk appetite in equities. Let's continue along to our dollar and rates. Mild pullback in the dollar. I'd be interested to see if this can continue. There is a seasonality approach, which I don't know that I'm a big believer in seasonality, but if you compare Trump's first term to Trump's second term, the dollar right about now should actually start to weaken in a material way, which of course would put pressure on rates to the downside as well, which would align with what we know is in the pipeline, so to speak, from the Fed as well. So watching that as an indication, let's get into our inverted ZT. Neutral in here. I would expect unchanged odds from the Fed tracker tool. I haven't looked today, so let's just throw a number out there. I'm going to say 65%. 65% for the odds of a rate cut in December. Let's go take a look, see how we did. 66.9. Okay. I was expecting the odds to come up, odds to come down a little bit. Noting that I think we were at 69% odds on Friday morning or something of the sort. So anyways, still right around that ballpark. The curve's still flattening out, not much deeper than about 3% on the 2-year here, or the Fed funds rate, which practically the 2-year is a reflection of. And therefore, as we know, there's about a 1 to 2 point spread between the Fed funds, the 10-2 curve. So the 10-year, getting my numbers all sorts of squirrely, the 10-year basically should not be any lower than 4%. Right, a 4% floor on the 10-year makes sense if this is what we're pricing for the Fed funds as we move into the future. Lowest is 3%. If you want a 10-year that's going to back off to like a 3.5, then you probably need Fed fund futures to start pricing in something in here, right? And we're just not there. Just not there. And we're probably not getting there either, because if we take a look at some of the data we got last week, let's go through these numbers. I want to talk about the manufacturing components of the ISM survey reports that came out. The actual on employment beat prior, and it also beat the consensus view. Generally, you could see, where is it? Sorry. Maybe there was no consensus. I could have, forecast. Here we go. Duh, it's just shifted off to the right. You could see it beat the forecast view here. So employment situation being stronger than the expectations. We could scroll down here and we'll see a couple of other major ones. If we look at ISM services employment, there we go. You have your actual at 48, prior at 47, forecast and consensus at 47s. You beat that. So the employment situation is stronger than the market was expecting. Where's the ADP non-farm? ADP non-farm, where are you hiding? Did they not flag that as a red star event? Should be Tuesday, right? ADP non-farm, where are you? There it is, ADP employment change. My apologies for going by it, but 42K, beating the prior at negative 29,000, which was revised. That this is little registered means. It was revised up from negative 32,000, and the consensus view actually wasn't this. Wasn't negative. Sorry, was it negative? No. It was 32,000 positive, I believe. They have it over here. Let's go to the Forex Factory. They have this one a little bit more clearly. There you go. There's your red folder event. There's your forecast at 32, and there's your beat at 42. So they don't do a good job of breaking down the manufacturing employment or the ISM services employment, but they do a better job of giving us this here. Anyways, the point of the story, the reason why I'm spending some time on this data is that if the labor situation is stronger than the market is expecting, what does that mean for the Fed? They could probably keep rates higher for longer, or at least not cut them as harshly, right? What else can we look at? Well, consumer sentiment and inflation expectations. Sentiment got worse. Inflation expectations got worse. What does that mean? Once again, rates higher for longer or not cutting as aggressively as the market was originally anticipating. This, to me, would mean that the 10-year at 4% probably stays for a little while. Let's go on over to the earnings calendar for the upcoming week's worth of trade. Sorry, let's look forward on the calendar before we look at the earnings. All this stuff is tentative, probably not much, probably not to be released until the government reopens. Just looking for any private stuff. Survey says no, nothing that's going to move the market too much. All right, so we'll let that be. Sorry, I thought there maybe was something that we could be interested in, but there's simply not. Some of these hot old names into the end of September, early October will be reporting earnings this week. Rigetti on the quantum front. We got IO&Q last week. CoreWeave has really been taking a beating recently. Big Bear AI is kind of interesting. Rocket Lab, ASTS. I'd say these are all kind of like small honorable mentions as we come into the early stage of the week. NBIS is a decent watch. What else? Fake Meat has been on a tear recently, although it's faded almost all of it. Oklo on nuclear. And what else? Honorable mention. Circle. IPO lockup is on December 2nd, the expiration there, so we'll watch that very closely. It's right around the corner. Other honorable mentions. Cisco, yeah, just because it's an old guard of tech. Anything else that I'm interested in? Disney, maybe. I know a lot of people will be watching Red Cat. Applied Materials is interesting for the semiconductor space. And I think that's mostly it. Yeah, I'm going to call it at that. Those are the things that I would think are honorable mentions here. Everything else is really lower tier. Nothing of the earnings calendar is really going to move the market. If you said you could only pick three, what would the three be? Probably CoreWeave, probably Circle, and I'm just thinking about different sectors here, and then probably Applied Materials, right? I know these sort of overlap on semiconductors, CoreWeave / Applied Materials, but that's kind of where I'd be at, right? Anyways, let's continue along to the earnings insight. I just want to point out one thing here, which is kind of notable in terms of the theme of the market. If you've made it to this point, then hopefully you're making use of this insight. But the market is not just punishing negative EPS surprises more than average. It's also not rewarding positive EPS surprises. I think that's something that would have been more, I think, tactical to write. I'm not here to critique this. This is very generous that FactSet puts out this free report. But if you've noticed, Palantir earnings last week, big beat, big guidance going forward, and the stock gapped down and continued in the downward direction. Same thing with AMD, same thing with Robinhood. So to see these names report decent earnings and then the market still sell off is kind of starting to show some cracks in the armor. We talked about in the intro how the AI trade and the overvaluation there is becoming a theme. There was actually a headline about this on Friday. I don't think it's going to be preserved here. I think it's going to be gone. Here we go. Wow. Believe it or not, it stayed. There it is. AI valuation fears grip global investors as tech bubble concerns grow. That is the headline, right? So that's sort of what's in the mind's eye of the market right now. As we saw from a technical perspective, right? I don't think it's full-blown risk off yet. But this headline at least is circling the narrative, and that's sort of what caused the market to move. Inspired sellers, right, into the end of last week. So anyways, it does align with what we're seeing on earnings and the lack of follow-through or reward on really positive EPS surprise or guidance surprise in the upward direction. So I did think it's worth pointing that out when it comes to the earnings analysis. All right, let's jump back on over to the platform. Let's round up the rest of our supporting evidence. Bonds, anything over here? I'm checking for the first time actually today. Nope, nothing worth talking about on that. Moving in sync. Credit spread still an issue. I'm not worried about this uptick, but I do want to see this roll over sooner rather than later. Here's the holy grail we talked about in the intro, which is the junk bonds in isolation. Let's go SPX down below. We talked briefly about it in the intro, right? But here it is in real time. Note how this, right, was only an equal high, and it's just all about the divergence. This was an equal high in junk, whereas we got a major higher high in the S&P weighted. Clearly, that didn't stick. Notice how this broke for a lower low, while this was still making a higher low. That is a warning sign, right? Then we got the follow through to the downside. Notice here how this to this is a lower low on the SPX, but in the junk bonds themselves, and this is really the call out on Friday, you got an equal low. You never made a lower low. You didn't even make a lower low relative to this over here on junk bonds, right? So when I'm considering that, I'm thinking to myself, right now, junk bonds are actually poised to continue possibly higher, closing, there's a gap in here, to close some of the overhead gap. If that's the case, maybe we do get that recapture in the S&P, and we do see that move in the upward direction. If this is primarily a range that we've been trading in recently, the junk bonds have been doing a pretty darn good job of supporting the bottom end, rotating to the top end. When we get up here, we're cautious again in the S&P, right? And if we roll over, after setting, let's say this sets a higher high from here to here, but this just makes an equal high, or heck, even a lower high would be worse, then we're cautious. We don't want to be buyers here, right? So this divergence in the junk bonds, it's been, I don't want to call it a holy grail, but it's been very, very, very helpful for market participants. If you've been watching this, it's prevented you from getting short at the worst time, and it's prevented you from really getting aggressively long at the worst time, which would have been just chasing the highs up here as you remain divergent with an equal high on junk. So continue to watch that as we move into the upcoming week. Let's take a look at breadth. Breadth, as we know, has deteriorated, but has stabilized after deteriorating. So I'm not overly concerned for further follow through. It's just a matter of watching to see how it resolves. If it does break down, that would be an issue, but based on the RSP, you could see here that we still aren't producing these major lower lows, and therefore I'm neutral until proven otherwise. I don't think we have a breadth concern for continuation yet, especially seeing what's going on here with our S&P sectors continuing to get rotation. QQQE, similar story here, staying over the bearish and goal for low, not making a new lower low. If it does make a new lower low, that would be a red flag. We'll monitor for that when and if it happens. Volatility has spiked, but it did not close over 2050. It's actually reverted to the mean already. If we take a look at VVIX, we'll see that this is also right at that key little like ignition point. Remember, 103 is ignition, 120 is like duck and cover. That's rough. If we take a look at vol futures, working towards a backwardation on the front side of the curve, but everything backside of the curve, strong contangos, still looking really solid there. 9 versus 30 looks good. And once again, I'll reinforce this and I'll say it one more time. When and if we get an open on the VIX one day, down here towards 745, game on, rock and roll, continuation to the upside in the S&P 500. Let's jump over to our core list of companies. Let's give this a little refresh and let's get the job done here. A lot of these charts you could start to simplify and start looking for some cleaner ranges. There's a lot more volatility during this pullback, so it is worth just pointing out, you know, these ranges will be wider above versus these tighter ranges below, and volatility was not so elevated, so to speak. Right now, I'm seeing that we are supporting over these prior highs on NVIDIA. This is a 100% retracement on the give back. The next big watch is just whether or not this sets a lower high and can fail underneath 185. That would be a major concern for the AI trade, noting that this is still the top dog in the S&P 500. NVIDIA is. They have earnings not this week, but next. I believe I'm getting that right. Let me just double check. Yeah, on the 19th. 19th is, it would have been on the earnings calendar. Glaring. So not a major issue as of right now, but this level is the top watch. Can you stay above it? And if so, you got to just start reclaiming levels up above. If you can do that, maybe you start to retrace this thin structure, right? What goes straight up comes straight down. If this goes inverted head and shoulders here over the neckline, reclaiming the daily 20, you're probably talking about a retracement towards, this area up here. I'd say 198.75, 202s, this double top neckline revisit. All right. If it's going to roll over, so lower high and then back here, that would be the major concern. That's where your daily chart runs into much more issues on NVIDIA. Let's go Microsoft. And I think I actually want to start on the weekly chart for Microsoft, just pointing out, of course, right, double top-ish. It's more of a concern when we start breaking sub 490. We're not there yet, but it certainly looks like it could be a threat. early on in the week. Also on the weekly chart, you can see very clearly these equal lows. 1, 2, 3 equal weekly lows. On the hourly chart, it's a clear shelf in here, and therefore one of my watches this week will just be if Microsoft rallies and can reject for a lower high here, that would be a beautiful setup to continue the downside pressure into the neckline, possibly front-running the entry there, lower high on this, risk reward into the neckline, buttoning up some shorts here, trying to get continuation in the downward direction if it starts to crack on that higher time scale. Let's go back on out to a daily chart here. Where is all this invalidated? Of course, it would just be on a recapture of 506.50. If you reclaim this level right there, bears really don't have it going on. I'd maintain more of a neutral stance on softy. Let's go with Apple. High and tight consolidation. Great relative strength out of Apple, clearly in a much stronger trend here. If this can just stay elevated, then possible breakouts on recaptures of 273 could be the next long trade on Apple. If it starts to pull back, a major spot to watch for a higher low on the daily is in here at 258.65. On the hourly chart, if this were to go gap fill reversal and support the daily 20, I would also entertain long ideas off of 264. Chart looks really good on Apple. Huge relative strength. Typically, this moves best when we have a catalyst, so we'll watch to see if there's anything coming down the pipeline. But for now, a little bit more neutral to bullish as opposed to bearish like we've been in Microsoft and even NVIDIA a little bit with its 100% retracement. Amazon, great pullback. I love the daily hammer. Why do I love this so much? Let's go to a weekly chart like what we did for Microsoft. But in this case, it's a bullish situation. Prior all-time high, prior high from in here. Call it a V-shaped cup with handle. Whatever you want to call this, call it a weekly bull flag. Doesn't matter. This pullback here is right off of the retest level. So, in my view, if we could get Amazon to start to step up here and follow through over the hammer high from Friday, this could be an add in the long-term accounts. This could be a nice long as a short-term trade, lifting back up through some of this earnings gap up range, supporting over prior all-time highs. I get it. There's still a large portion of unfilled gap underneath us, but if this hammer is going to be the end-all be-all signal, I would love to see acceptance over Friday's high, seeking continuation in the upward direction, holding prior all-time highs we just explored on the weekly. From the hourly chart, you could start to see how this maybe goes inverted head and shoulders, and that acceptance over the neckline, which aka is just Friday's high, starts to look really compelling for the hourly trend reversal. Let's go Google. Let's take a look at the daily chart here. Great relative strength, very similar to Apple. With the relative strength here, you can see how this consolidation probably means sideways bull flag at the highs when and if we have a market that returns to momentum mode. We're all, over the all-time high looking for new blue sky levels. Or if the market's going to continue to go sideways and chop around, I would be very open-minded to Google actually developing a stronger pullback underneath these lows for something that looks like this to the daily 20. If you look at the hourly chart, nice bear flag consolidation on Friday. This opened higher in the range, could not support over this previous high in there, so the ideal bullish look would have been this for a higher low to persist. As of right now, bear flag consolidation underneath means that this is okay, right? This is thin structure retracement. Not the biggest fan of throwing a volume profile on everything, but we could just take a peek real quick. Let's go intraday volume profile. Yeah, I mean, look at the high volume node overhead, and this is, I think it's fairly straightforward, but this is your nice break and thin structure to the upside, but the volume's just confirming, right? There's really not much here until you come into the previous shelf and breakout level retest. So I'm liking Google. I'm liking that possibility of a pullback, just like what we saw in NVIDIA. What goes straight up can come straight down. I think because there's such thin structure, it might just become a compelling trade based on the tempo and speed in which that move can unfold. Let's go along to Meta. Let's just give this a little study reset to our daily moving averages. There we go. And we'll take a peek at the daily chart first. So a lot of damage done to Meta, failing the daily 200, closing some of these gaps down below. This chart's a little tough to me. It's tough to chase this smack on the lows. I would love to see some kind of counter trend rally that rejects for a lower high underneath all of this overhead supply possibly. This in here would just be bearish as well if we get stuck in this prior consolidation phase. Meta's chart right now to me is very loose. It's not tight. We don't have clean levels. I would be a little cautious of getting aggressive on Meta until this really starts to tighten up in terms of its reference points. These things have just been adjusted, right? Some of the prior levels ran through, and I've adjusted them to follow more of the structure that's recent and more relevant. So it may look clean right now, but it has not been clean as it's been trading. The only clean thing has been this at 647. So bear flag consolidation, I mean, continuation, you could kind of trade this as a straightforward chart on the smaller time frames, but the daily chart's not so clean. That sort of downward channel in here. If you reject this 626.25, maybe that's your lower high for continuation back to the low 604. We'll see. Meta is kind of like I said, looser. It's on pause for me. I can't remember the last time I traded Meta, if I'm honest with you. Good to keep tabs on, though. It's still a heavyweight component of the market. If we take a look at Tesla, pay package approved, $1 trillion. Can you imagine that? Trillionaire. Balance range up here is just a junk drawer. We either take out the highs on a bullish catalyst, and we know Tesla's going to have one of those days where pre-market it's doing 2 million shares by 7:30 and it's just off to the races. Maybe even more, 5 million shares by 7:30. If it's going to be to the downside, right, this downside pullback, thin structure through here, you could probably do the same thing, although this may throw it off from a high volume node perspective. Let's just do it. Why not? We've just been using this thing like crazy. Yeah, I mean, look at this. High volume shelf, low volume void, high volume shelf. What goes straight up can probably come straight back down. That would be underneath about 412.50. If we take a look at the hourly chart, there it is. There's the bottom end of the range. Notice on Friday the consolidation underneath this little subsection of the range, 440 breaking down. Not so clean intraday, but nonetheless, in the lower portion of the junk drawer, looking for possible downside underneath 412.50 as a possible idea. Let's go back to this daily. Let's reset our study set here. That's fine for now. And let's keep moving. So that's Tesla, maybe shorts under 412.50. We have JP Morgan. Looks bullish. I would say that this recovery has been solid. Staying over the 50 SMA, 20 SMA, 303.80 is bullish in general. I like the breakout attempts into the end of the week. 312. Consolidation here and continuation is bullish as well. So the big banks looking more like financial activity on Wall Street's continuing strikes me as a healthy sign for the market rather than, oh my God, we're about to fall into a recession and nobody wants to do business. If we look at Palantir, huge breakdown on that Thursday session, but right into this key area of support. If anything, I would think, okay, first thought is, does this bounce? Right? Does this bounce after a 100% retracement? Do we get some follow through? The next big watch is just, does this turn into a lower high? If you reject the prior junk drawer high, right, this top end over here, then guess what? Well, now you just have one of these, left, head, right, under the neckline, sayonara. When and if that takes place, we will call it out. We will try our best to execute on it as seamlessly as possible. But for now, hammer off the bottom end of the range, closing back inside of Thursday's body. I would think upside to at least give it a test at 187.25. So that is Palantir, inverted head and shoulders, pullbacks for higher lows, ideally over 175.25, and seeking continuation through this thin structure breakdown, 187.25. If it just goes bear flag consolidation, this will be a larger break to the downside as well, noting you would have all of this as overhead supply, looking for this breakout point at 163.50 to be the first major target. Next up, Broadcom. Broadcom back into this chop and slop. I'm not fond of this chart. If it was going to be clean, it could have done really 2 or 3 things, and it did none of them. This breakout could have yielded a higher low over the prior all-time high, no dice. Okay, deeper pullback can possibly do this. Pullback and support over previous resistance, acting as new support, daily 20 SMA, didn't do that. And then after the overshoot, on that Thursday session, you actually opened back above the level. So you could have gone look below and fail on the key level from back here as well, and that still would have been bullish too, and obviously on Friday, that did not take place. So not as compelled to say anything really about Broadcom in this chop and slop. It tends to be a little bit more of a spready trader as well in the options chain, so I'd be a bit reserved here in Broadcom and wait for some more clarity around specifically 358.25 and this prior high at 372.25. Let's move along to AMD. AMD had this ascending triangle retest here, no dice with the move on Friday. We did get a hammer inside the range, so the big watch is just whether or not you rally and reject underneath 243. We've seen this as a theme across the broad market, right? If this is going to be the issue, then we're dealing with a much stronger reversal. If we can recapture some of this stuff, or if we could even just go sideways and not break down underneath the low here, that would be bullish as well. Sideways digestion through time after this massive gap up. Remember, AMD had decent earnings, but what happened? The stock moved lower on the report. Okay, that's AMD. Last but not least in the core list is Robinhood. I think everybody can see the major weekly double top. Underneath this low, things get squirrely. I don't know why the level is not on there. I could have swore I did my homework and this gap was mapped out, but let's just do it together. 109.85 is going to be the top of the gap, and then the closure of the gap down here at 106.25. Very straightforward, very simple. Let's just update our levels as follows, and then these major lows here will come in primarily from that gap down opening print is what we're targeting at 97.50 for round number 6. That'll do for now. So we can see the double top. And once again, it's not a double top until it is, which means you need to do this, and then we target the gap close, and then we target this level. But if we're just supporting off of the key area, guess what? I mean, neutral, right, at best in terms of overall trend. I would say if you set a lower high here, that would be detrimental. You have this overhead supply, lower high in this area at 137.10. is going to start to be where I would look for a short. If we go down to the hourly chart, you could see this. So, head and shoulders, draw whatever you want to draw. It doesn't matter. But this kind of move there. There's your thin structure retracement to the origin of the breakdown, daily 20 SMA retest. I would say shorts for lower highs. Definitely could try to balloon runners that look like this. And then, of course, your daily head and double top, triggers when and if we crack the gap down here. If this is going to recover, you need to be in this range. That's probably a big old PITA, PITA, to trade inside of this range from prior. It really didn't show any respect, Robinhood that is, off of 141, which, as we were talking about in the past, was the conjoined twins neckline from the double top there, the double bottom here, just straight through it, chop through it all over the place in this little range. So not as thrilled about Hood. All right, I've got two ideas. One of them is a follow-up to a previous idea on Snowflake. Let's jump into Snow. So there was this move lower underneath the neckline, unfortunately, of the head and shoulders, right? That looked like that. Unfortunately, it happened via a gap down on Friday, but notice how we have a hammer now over this breakout point. I would get rid of the bear thesis and start thinking more about the bull thesis. Can we get a nice trendline support hold? Can we get a hammer high breach? And can this just look like a bull flag in hindsight over the breakout point for a retest? So over 263s, I would start looking back for upside on Snowflake. And then the last one, BMNR, is Tom Lee's little darling here, supporting near the bottom end of the range. There was a big announcement, not that I'm a big believer of like following big money and doing this, doing that, but there's a big announcement that JP Morgan actually was a big buyer of BMNR. It was either BMNR or Bitmine, or Bitfarm, BITF, I believe is the ticker there, not MIT, BITF, Bitfarms, yeah, there it is. It was one or the other, but the point is that some of these crypto names, even this, I suppose, could go on the list as a watch. I'm not a big fan of trading, this cheaper stuff, but Bitmine, or Bitfarm, BITF, hammer off the daily 50, previous rejection high, now acting as support, BMNR at support, right? So some of this stuff is kind of interesting to me. 39 holds on BMNR. I'll just leave it with that. It's not like my top priority. It's not a top idea, but these things are at least in the sphere of influence and maybe worth just keeping a eyeball on. Not both eyes, but maybe just one eyeball into this upcoming week, all right? So that's what I've got for you in today's episode of the weekly watch list. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. I would encourage you, I started with the video with this, I will end the video with this. Please watch the HYG. If you don't know what junk bonds are, just go do a quick Google search, ask ChatGPT, ask Perplexity, Gemini, whatever your favorite little chatbot is. Go figure out what junk bonds are, look at the bearish and bullish divergences, and use that to your benefit as you come into this upcoming week's worth of trade. It's been immensely helpful, and I imagine that it will continue to act immensely helpful. Again, if you enjoyed the video, all the clicks, the buttons, the like button, the subscribe, the whatever, the this, that, the other thing, links in the description. And with that said, have yourself an awesome weekend. Have yourself a fantastic and green trading week ahead. And as always, I will see you in the next one.